That's the great thing about the dated Brent market. It gives you real indications of what the physical differentials will likely be in the coming weeks. And this is why we love it, because this is real physical signals, real physical information ahead of time. So you can't possibly model this with supply and demand because it's happening in the future, and supply and demand is taking a day one or day minus 10 and then extrapolating to the future. Hi everyone, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, the Chief Executive of Onyx Capital Group. I'm joined today with Vincent Wu of the research team, and we're back to talking about markets. Now, the oil derivative markets, the oil markets in general, are all in wait and see mode ahead of the OPEC meeting. And we've got a presentation that we've done, that we've sent to clients, and we're going to talk through today, which is summarizing the market position state as it is today and some of the recent moves and shakers and how we see the sentiment using our data set. I think the general thing was, an overview of the sentiment in Q4. I wanted to focus on the recent big moves because, of course, we had the first big sell-off in Brent down below $90 per barrel on the psychological level at the very beginning of Q4, just before that. And then we had, obviously, the geopolitical conflict bounce back and then a second sell-off. And the market kind of made material shifts during that time.
There was a clearly shift towards a bearish regime in recent weeks. Firstly, coming off from 90, the Israel-Hamas conflict briefly sent prices back up to 90, but that always felt like it was going to be short-lived. The war risk premium came off really quickly as soon as traders and market analysts became really fatigued about that narrative, and all of a sudden 2 weeks ago, flat price sold off to its lowest level since July, briefly came off below $80 in front month Brent. Although prices are back up in the low 80s now, it did feel like last week there was a bit of an overcorrection to the downside. So we're back into the low 80s, and so the market narrative is really turning towards, okay, what is OPEC going to do next? There has been a sell-off. Are they going to keep on? Are Saudi Arabia going to continue their voluntary cuts? What's going to happen for oil prices looking into 2024?
Yeah, I think very, very recently, as in even yesterday, and I think this morning, we're seeing some indication that there is some opportunistic buying ahead of this meeting. It seems like a good risk-reward trade, given we've had a big washout. And generally speaking, traders sitting back. And I did communicate that we feel that the collective sentiment or collective positioning, which implies the sentiment of traders, was not just the macro financial players, the hedge funds, the prop traders. It's also the physical, the commercial based players. And there's an alignment in kind of the negative, I guess, view on the price, and that's kind of was the basis of the argument. But as always, you said it was kind of like an overcorrection downwards. That is the nature of the market we're in these days. When you have a big de-risking event, we've got CTAs, a lot of algorithms in the market who are jumping on the trend and who are following quite straightforward signals like the 200-day moving average being broken. That triggers selling, and that exacerbates any move. So we kind of overcorrected down towards 77-ish, and has since bounced back as the kind of end of the trend, I guess, or the recent trend. So going back to the first sell-off, and we have covered this in the first, in other podcasts, but the first one at the beginning of Q4, I think what we wanted to retrospectively focus on was that there was talk about it being blamed on speculators, and that's a generic thing to say, right? It's the speculators. But I think what the general understanding when you say speculators, at least from the oil industry's perspective, is that means hedge funds, that means people just chasing short-term profits. But of course, every area in the CFTC report, the trade houses, the majors, even the banks to some degree, the prop traders there, and the hedge funds, they all take short-term positions. They all have speculative sides to their strategies. That's one thing. But I think the main thing was, it's clear in retrospect that the weakness in RBOB is what started this all off. There was a very significant correction in RBOB in late September this year, which from the evidence, we could probably get it up. Yes, we've got the graph up here, and it's pretty it's very clear that the RINs was driving this RBOB sell-off. And the thing about RINs, it's US government mandated. It's a very US focused thing. There was talk of strong soybean harvests, renewed Russian gasoline exports, weak driving demand, and RINs weakening. Like it's not a heavily financialized contract by any means. You can trade it as a financial contract, but ultimately, people genuinely need to buy and sell. It's very similar to carbon, the way carbon's traded. So I think any material move in the RINs is genuinely significant. And I think from the evidence, we can see that in the CFTC report at the beginning of this sell-off, we're looking at the swap dealer category in the CFTC report for RBOB. That's giving an indication that it's transactions done from investment banks, and investment banks hold the vast majority of bilateral relationships with refiners and others, but in this context, the refiners. And the refiners were clearly selling RBOB as well as probably selling RIN certificates in the RIN market. So it was absolutely a risk-off move, seemingly driven initially by a genuine fundamental argument with the RINs. But it was chased down alongside with macro money. And there's also rumors of financial traders being aware of the indexes, so needing hedge funds, managed money holding a long RBOB position for a ETF or ETP, needing to sell the front month and buy the next month, and they were trying to get ahead of that ultimately. And that sell side positioning, alongside the RIN moves, alongside general trending south and CTAs getting involved, it just created like a big bang. Ultimately there's a huge sell off, and it was very aggressive. And ultimately, the key thing here is that the buy side liquidity needed to come from somewhere, and although it was very thin, and hence the move downwards, there's evidence that there was stop losses and everything was very aggressive, but it ultimately had to be bought by someone. And it looks like the producer merchant section took all the length, did all the buying in this sell-off. Now, you could argue that's the section of the end users. The end users would enter new longs. That's their general MO, right? They buy as an end user to hedge. But the thing is, with gasoline, there is no buy side hedging. There's the buy side is going to be from oil traders and majors, but the actual end user is the everyday person, and as it stands, they have a very low influence on derivative pricing. They don't go and buy hedge themselves. There's no utility really buying. It's all part of integrated systems. So generally speaking, RBOB tends to be a speculatively long positioned contract always. It's either long, very long, or extremely long. So ultimately you can see that the kind of lowering levels were taken on by the trade houses and majors, most likely actually from a speculative point of view. But interestingly enough, 2 weeks later, as we kept being weak, even these large trade houses and majors clearly couldn't handle the weakness and actually exchanged hands with the shorts that were out there. So we basically just had a couple of weeks later a de-risking situation where everyone closed their positions, and the net result was an open interest decline. Clearly a lot of people hurt, and it just a bit of a shocking move in general. Now, the conclusion of all this was that it may have been seemingly a flash in the pan, but it was significant enough that the turbulence had a contagion effect on the crude futures markets. And I think that's where it gets interesting for what we're talking about. So that's what I'm saying. You can see on this slide here, the correlation moved from minus 30% for the RBOB versus Brent crack versus Brent futures to suddenly 90% during the sell-off. So very much a lead lag RBOB into Brent futures. Now, during this time, I think maybe you can come in here a bit, Vincent, but we noticed that the North Sea market, great indication now that it has WTI Midland especially. It's a great indication of the underlying physical market. It's the best you're going to get for the forward market. And the physical differentials in the spot market were approaching or above $2 per barrel. Now, by any estimations, this is a strong level, right? This is historically a strong level. This is heavy backwardation. The Brent spreads were still in strong backwardation. Obviously, they felt the hit a little bit as Brent sold off, but ultimately stayed strong. I mean, that's...
Yeah, at the time, the physical market was still looking extremely strong. It's also worth mentioning the end of September was also during that time where WTI Cushing stocks in the US was seeing extreme tightness. and WTI spreads really ripped high during that period. So there was genuine supply tightness concerns in the market, as well as the fact that flat price was in the mid-90s at the time. So when gasoline sold off, crude was still, the market was still in this was still very bullish about crude oil, and you had both the speculators and the financial flows, as well as the strong physical market to reflect that, because now North Sea is very much more correlated because of the inclusion of WTI Midland into pricing. So it is almost like stronger North Sea fundamentals is a reflection of stronger US fundamentals as well. Basically, at the time, physical market was in very good shape. So potentially it did not immediately affect the crude market, the gasoline sell off, but later it would have, because initially you need to remember that gasoline cracks were extremely high previously in August and September, and it was also overextended to the buy side as well. So that sort of, because initially the notional value was so high, the sell-off, it was also, fundamentals were turning around, and a lot of existing length were also taking profit at that time. At the same time, perhaps because refineries see that the margins are so high, they're rushing to hedge and produce the product.
No, that's a good point. And I think just going back to the presentation, if we go to the next slide, I mean, this is kind of echoing the same thing in RBOB. You know, during this sell-off, Brent futures, the producer merchant section of the CFTC report was absorbing a lot of the sell side flow on this sell-off, which is a great indication that, generally speaking, the commercial players weren't really believing in this sell-off. Ultimately, as everything we just mentioned, the underlying the signals there seem strong enough. There was a general bullish consensus from the professional oil traders in the market. Having said that, end users do come they do hedge, with Brent futures, and it was likely there was some opportunistic end user buying during this sell-off as well. But I think where it got interesting is the next part of this presentation is, we know we had this Israel-Hamas conflict, and we know that was, generally speaking, a bullish event, but we've got to be careful with saying it was a bullish event. It had a bullish impact on derivative prices. It had zero impact on physical, but yet it changed a lot of, people's mentalities, clearly, this volatility. So the volatility clearly spooked traders, and you can imagine if you're buying speculatively on the way down after such an aggressive move and then you get a rebound, there's an element of you loving it. Obviously, you've been able to be like, great, make a quick, it could have been as much as $10 per barrel in a very short period of time. And you've got to think, well, what now? Why ultimately, if I've made such a return so quickly and I've had this relief, I've gotten completely taken unawares by the market selling off, and now I've been given this second chance. And I don't really believe at all that this conflict, or there's no evidence that this conflict is going to have a contagion impact on the physical market. So this really is a great time, if I've got any insecurities at all about my position, to sell out, because if anything, you're going to make money, or at the very least kind of not lose too much from your overall position, given this conflict brought Brent futures back to mid 90s, almost the highest of the year. So it was a great opportunity to sell, and that is what the market did. I think the producer merchant section, again, that's where a lot of the shorts came from, and if you can see the short build up during this crisis from the producer merchant side, showing they are essentially either getting short or taking profit, or de-risking. And the money managers, the hedge funds, took on this length. Now, this is not surprising, right? This is how it typically works. You have an event, it's talked up in the media in particular. You had a lot of analysts. I think one analyst even said in the FT, no one in their right mind would hold a short position in this environment. And I think it would have been very difficult to justify to risk managers being short during this time. And if anything, not being long, if it's your job to make speculative moves. I think being long was you kind of pressured into it. So what you were left with, what the evidence suggests that the market was left with, is a macro fund retail kind of positioning that was left holding the baby, if you like. So they were left long as all the professional oil traders actually started to get out of their length. And it proved, great timing from these traders, because ultimately the market started to kind of ease out from that conflict, and all the de-risking or risk protection trades like buying calls to protect you from upside, that all filtered into buying flat price. All this length that was coming in to protect against this contagion from the geopolitical conflict. Suddenly, now it was like, well, it's not going to happen. That flow has got to be getting out of it. It's not going to be held. You need, if it was on for a risk-off reason or to avoid, to protect yourself against adverse movements, then once there isn't that situation anymore, you got to sell. So you had a wave of selling, and then we had this second sell-off. And Vince, do you want to say, but this time on the second sell-off, you could look at it two ways. Did the market, as in the professional oil trading market, the majors, did they get it, very great timing, took the signal, sold, and then suddenly the underlying physical market deteriorated? Or given that everything, even the physical market, is traded in forwards, maybe it was just a situation of, how do I say this? They were getting out of their length and they were getting short. So then therefore they started to have, a bearish sentiment for the physical as well. So things like the time spread and the physical differentials, well, naturally speaking, they also don't buy them up because of this. It's a collective sentiment thing. Do you see what I mean?
Yes. So it's all related to each other. And from the graph on the right, you could see for the physical differentials in the North Sea during the first sell-off was much higher than during the second sell-off, which was also skewed, which was also going up at the time because of a bull play by one of the players in the physical window. So that kind of magnified prices a little bit. But the key point is the physical market sentiment and Brent spreads were already on the way down during that time. So not only were the speculators feeling really bearish, but you could say that the physical markets, the traders, the people who are moving the physical oil around, are also feeling quite bearish as well. So you imagine previously you had one or two guys in the room out of 10 people are feeling bearish, but now you have 3, 4, 5, 6 people. So really, in the sense that there's this herd mentality that catches on, there's this bearish momentum. And finally, when Brent futures came off into the low 80s, crossed below the 200-day moving average, that was a signal for algos and CDAs to come in and continue the selling, or potentially even having a lot of existing length taking profit as well. Yeah.
But I think the key thing is the physical differentials this time round. Again, back to the presentation, you can see the clear distinction, right? I mean, it's still high on the second sell-off, but starting to deteriorate. And now, if you look at the Dated Brent curve, you look at the forward differentials, that's the great thing about the Dated Brent market. It gives you real indications of what the physical differentials will likely be in the coming weeks. And this is why we love it, because this is real physical signals, real physical information ahead of time. So you can't possibly model this with supply and demand because it's happening in the future, and supply and demand is taking a day one or day minus 10 and then extrapolating to the future. So here we have a situation where traders are taking a forward view on the physical differentials that they're going to be lower and lower and lower as time goes on. And the time spreads even dipped into contango and Brent futures time spreads. And remember, Brent time spreads are effectively a physical differential once they go into expiry. So physical differentials or premiums, if they're negative, it's weak. If they're positive, it's strong. It's as simple as that. And eroding all the backwardation is a very clear signal that the market suddenly does not believe in this underlying strength as much as it did. And it did seem, the point is, everything started to correlate, everything started to deteriorate on this second move. So it is a collective move bearish, and I think the positioning, as we said, suggests that. So this is all quite interesting, and ultimately it's just the state of where we're in. But there is another argument, which is like, okay, but we're just in a risk-off environment, right? We are just, at the end of the day, there's quite a lot of work to be done in a bullish market. You have to take these barrels at strong levels. You then have to market them around. You have to have a lot of confidence in taking these forward barrels as an oil trader. And that's what gives the forward prices. And then, ultimately when it becomes spot cargoes and you sell them to refiners, you've got to have confidence that the refiners actually want them. And there can be a lot of money made or lost in that in that time lag. So you buy them, in December loading, you got to wait a few weeks before you market them to a refiner or that process. And if you're starting to lose confidence that those cargoes you're buying at these strong levels aren't going to be able to be bought up at those similar levels or higher, then you kind of start to give up. And I think that is the state. But another really interesting thing which I brought up yesterday was seemingly the shift in light versus heavy sentiment. Now, again, if you talk to the average trader, you read the supply and demand analysis from analysts, banks, this kind of thing. They're not going to tell you this, right? They're going to say, no, absolutely not. OPEC are in the middle of a cut. It's a tight market. If anything, there's way more light sweet coming online. That's fine. But the evidence on how the actual market in its constituent parts is positioned is much more skewed towards light versus heavy now. We've had a long time of depressed light kind of markets and light crude and light product markets versus very strong heavy, and that's been great for a lot of traders, right? Riding the bullish market in residual fuel, VLSFO, gas oil, but now it's starting to correct, or the positioning is starting to suggest that people are betting on this kind of basically correcting. And that could be to do with Venezuelan production, sentiment on that, but also maybe just the general view that these cuts from OPEC have gotten to their, most extreme point. And if anything, the risk reward is that it will only get more. It's likely that will be more heavy crude, not less. And that's kind of what is being suggested by the betting on gasoline versus heat. Or gasoline versus gas oil. Funnily enough, actually, yesterday we did see some quite significant gasoline selling and gas oil buying for the first time in a while, maybe kind of going counter to this. But generally speaking, the way the market's positioned is more bullish the light ends products versus the heavy, which is an indication actually at its underlying that the light versus heavy crude is starting to shift. And I think the Brent versus Dubai is a great proxy for that as well on the crude side. Light versus heavy, Brent versus Dubai, and such a depressed market, heavily negative, for a long time. And this is historically very significant. And maybe you could talk about the positioning changes a bit here, Vincent. Yeah,
looking at the positioning stuff. So Onyx counterparty data for Brent Dubai paper swaps market showing basically a more bullish sentiment in Brent Dubai, which is a proxy for sweet versus sour crude and fundamentals. So we're seeing that majors have been flipping from selling to buying towards the end of October, and as well as the fact that refiners were buying less in Brent Dubai as well, less buy side flow, indicating a sort of a changing of sentiment where previously they were more bullish on the sour crude side, Dubai crude, Middle East reflection, Middle East production, but now because of the narrative that more heavy sour crude is going to be coming online, such as the easing of sanctions on Venezuela, it's going to be more supply and people adjusting the supply and demand balances, and therefore we're seeing a slightly more bullish sentiment for Brent Dubai. But it is worth noting that the market is really in a wait this week. Market is in a wait and see mode until the cuts on the weekend.
As you'd expect on the prompt,
yeah.
But the forward curve, if we're looking at 2024 contracts, which is a lot of what people are talking about is 2024 loading contracts, and the whole curve in Brent Dubai is in backwardation. So it's suggesting that there's a bit of a return to normal expected next year. Whether that pans out or not is of course unknown, but at least what we are getting at is everyone can say what they want to say, but we're looking at the evidence of positioning. And I think that from a overall positioning point of view is what the market, if the market could tell you something, it's telling you it's risk off and waiting, but it's also telling you that they're expecting kind of rebalancing of their light and heavy crude, which I think is very significant. And on the flip side, if you're very much against this view and you think that's impossible, I think that OPEC are going to continue to cut. I think I don't see the scenario. Then there's opportunity, right? There's the Brent Dubai backwardation to sell into. There's the light, gasoline and naphtha versus gas oil and fuel oil, for example. But I think when people hear these things, it's not about saying heavy is bearish and light as bullish. You can't just say that. It's more like, okay, what are the current prices that have priced in the movements of the year and everything that's been going on in physical pricing and positioning in general? And you start at that point, and it's about a relative thing, because everything's about relative to where you are. Not, you can't possibly sell if the market's bullish. Well, actually you can, because if the market's bullish and it's been priced in and everyone who can buy has bought, then actually it's a lot more likely that the market will move down. The risk reward skews, and that's how people have to think. You have to be dispassionate. You have to think about what has been priced in by market reactions and market positioning, not what you want to see the derivative market reflecting, given what the underlying physical view is. It doesn't mean people's supply and demand balances are wrong. It doesn't mean that people's view on physical is wrong. It means they haven't considered everything. They haven't considered the derivative makeup and positioning makeup as well as the physical. And that's the definition of knowing if things are priced in or value, etc. This is the big hedge fund game in equities. They create a valuation metric and they look at what's undervalued or what's overvalued relative to that valuation metric. Now, if something is priced in, you don't continue to buy it or you don't continue to sell it depending on your view. It's priced in is priced in. And then if it overextends, you might still have the same underlying view, but actually it's gone too far now. And that's why you have to have an idea of value ultimately. And I think we've gotten to that stage in the market that it's saying we've pretty much priced in as much as we possibly could have done the current environment now. If anything, it's gone too far. And that's the kind of the end of that. So going forward then, Vincent, we've got a very interesting week coming up. If we can now talk a little bit about if the market is in a risk-off mode and it doesn't have much interest invested, let's say, it was waiting to invest, waiting to put the money back into the market, it could go either way, right? And that will make headlines coming out in the coming weeks very interesting and probably quite impactful. So as much as we've slowed down in the last few days, it's probably likely it could pick up again.
OPEC meeting where they'll make their decision if they will extend the cuts or not. And of course the market does seem as if market participants, analysts are expecting Saudi Arabia to extend the voluntary cuts. So therefore, if they do not, then prices could be in for a very, very bearish move. So we're looking at it. It is a game of poker, trying to anticipate what other people will be, what other players are going to be doing. So you have that, but going forward into December, we're probably looking at macro events, macro headlines. Although perhaps potentially the oil market is a bit more risk off, you still have a lot of macro money, hedge funds, ETFs still in these in the Brent and WTI contracts. And at the same time, the recent flat price sell-off was also driven by a lot of financial selling, longs in WTI exiting their positions. So in a sense, in Q3, flat price has been very much also quite a bit has been US driven. So we have a lot of dormant positions waiting to enter potentially, if they stopped out length, if we're seeing more bearish moves, that could really fuel a bearish move downwards, price action going down to the 70s. So in that sense, perhaps we could be seeing more people buying put options. As for the bullish argument, we have to wait and see a couple of macroeconomic headlines as well. There really isn't not seeing so much at the moment though. It seems like if anything, OPEC cutting is the only thing keeping prices up. But if not, then prices are really skewed to the downside, the risk reward.
No, good. Okay, so interesting stuff. I mean, do you have I guess we could probably leave that there. We've spoken a lot about that situation. But a trade idea, Vincent, for this year? For this week?
For the week ahead, yes. There is actually. So just sharing my screen here. Had our Flux dashboard has been redesigned. So just showing off this fancy new look. So as mentioned in the video yesterday, trade idea of the week was to go short in the Jan-Feb seeing 0.5 spread. Yesterday when I suggested it was around 15 to 16. So it has performed. It was a combination of a momentum and trending trade, catching the reversal in the trend, because previously the VLSFO complex in Asia had been extremely bullish, in the sense that we had the Al Zour refinery outages, as well as limited exports because of domestic demand for electricity generation. So the market had been really bidding the spreads up, as well as the cracks, and the east-west. The arbitrage is open, but it's really reflecting a lack of supply coming from the Middle East. And you had a lot of counterparty data was showing a lot of trade houses and funds were also piling into the spreads and cracks. And as a result, because of a combination of fundamentals as well as financial flows, which has exacerbated the move upwards, spreads have really ripped up over the last month. And in the last week, though, we have seen a bit of an inflection point. And so on Monday, we saw that prices had begun starting to reverse. It's like, okay, we have caught the bearish trend, but doesn't mean that prices will continue to go down. But we saw that, okay, the market was overall positioned on the buy side. You had a lot of speculative length already in the money. And now, because a headline also came out that Al Zour refinery was actually returning to full operational capacity in a few days, that was a bearish headline, which turned into a liquidity event for these existing length to exit their positions. So as a result, we had this suggested this trade. So far it has performed, and initially we're thinking setting a wider stop loss because of really heightened volatility, but as prices edge lower, we could make the stop loss a bit narrower, and a good exit point would be if the market turns bullish once again, if the shorts take profit, and with an hour stop loss, a profit should be guaranteed if you entered at a very high level.
Okay, thanks, Vincent. We will leave that there, and thanks everyone for listening. Remember, please like and subscribe to our YouTube channel or wherever you get your podcasts. Thanks very much, as always, for listening, and tune back next week for more. Thank you.